You know, where the rubber hits the road is where you talk about the South Koreas, the Netherlands, and the Icelands of the world, and then how do you play that from a macro perspective? Because number one, obviously, when you look at how you would invest, say, on government bonds or any other asset class, it's not just about what's happening with the pensions, but also there is the relative factors, like in terms of are they relatively the relative value of the assets that you're looking at. So what's the process that you use in terms of putting this into an investment management component?
Yeah, one goal for us, of course, as investment managers has to be, so what, right? So
right, exactly.
It's great that you do all of this work and that you maybe write a paper and have this fancy model, but what do we do with that? So I think for me, one of the important pieces is that I want to educate. So I want to also show people, look, this is what's going on.
Right.
But at the same time, I am a paid employee, so I need to also make sure that whatever I do will have a positive impact on the tasks that I've been given. So for sure, we want to make investment decisions based on the information that we're getting. Mm-hmm. And I would say one is that it is an informational piece. So it is something where I'm not really saying you should have been invested like this yesterday, right? This is something that has a timeline or horizon which is still some time out. But what is important for me as a macro investor is to also look out into the future, right? Everyone is focusing on the 0 to 3 months, and we're also, of course, taking a look at it and making our decisions on a very short-term tactical basis. But it is, number one, it is highly competitive, and therefore there's a little bit less alpha in this space. There's more alpha if we look out further into the future, and that is a 1 year, 2 year, 3 year time horizon. And we need to be game ready. We need to have our game plan of how we want to be invested if something happens, right, which we think there's a reasonably high chance that this will become center stage. And we can talk about what will be the triggers to bring this center stage. But I think number one is we need to see, are there any glaringly obvious decisions that we need to make based on the model that we've seen and the qualitative analysis on the background. And I think the glaringly obvious decisions are that we look at Europe, because it's always easier to make those decisions within the same currency.
Right, yes.
But if we look at Europe, there we have one central bank, but we have multiple different countries which are actors in that environment. And then you have some, like Netherlands, which is extremely well prepared. And then you have others like Austria, which is extremely badly prepared.
Right.
And then I look at those two bonds, and as a bare minimum, I would say let's not buy Austrian bonds because they trade at the same level. And I think it's maybe 8 basis points difference, but it's not worth those extra 8 basis points for going from one country which looks, let's say, stable and solid and well prepared to something which on the surface looks decent, but if you look under the surface, there are a lot of challenges. And I will put a massive disclaimer here that this is not investment advice that you should put on that spread trade right now. This is more going into the direction, those kind of trades we would look at. And we also need to factor in, of course, what other pieces of information are there. Sure, right? So we need to factor in that Austria just got a new leadership, and that is actually extremely progressive and might be the blueprint of how European politics will look in 3, 4, 5 years, and maybe with that young dynamic tilted towards environmentally but still sustainable growth, maybe that is a framework which works extremely well for Austria. So we need to take all of those things into account. But if we were to just look at pensions, that is a pretty clear case to be long Netherlands and short Austria.
And can you play this in derivatives, like CDS and things of that nature? Because I would imagine that when you look at the price of those derivatives, when you're looking for, trigger events later on, when the trigger event happens, that protection will crystallize towards the values that you're already predicting.
Yeah, I think that's great. I think that's possible. So you could do those things. But I think what is maybe the more cost-effective way would be to wait a little bit more until it hits the most critically exposed ones. So I think having a good roadmap or a good game plan ready, it is okay, I think, to miss the worst case if you then play the second tier. Right? Because it will always trickle down. It will always be, there will be one country where it becomes center stage, let's say in Greece or in Italy or Spain or France, right, where you have a really big move based on what is going on in that country on the negative side. But then the second tier countries will not move for a very long time. So there will still, I think, be opportunity to put on those trades, let's say, let it ride for a little bit longer, but at least it is right in front of you, the playbook. You can just pull it out and say, look, I'm game ready.
Right.
And that's one thing. I mean, the financial part is one thing. Another one is politics, right? So there it has already a huge impact, right? Where we see how maybe the political divide in countries is not based on ideology anymore. It is maybe a little bit more based on the intergenerational split between the older generations, let's say the OK boomers, and the millennials and under, where you see, well, who's actually going to pay for it? Is it the young through the contribution, or is it the old or older through lower entitlements? So, and I think that's what we see increasingly in a lot of places in Europe, but also globally, definitely in other places too. So you have that financial aspect, you have that political aspect, and then you have, let's say, the really big structural impact of saying, like, okay, how big is that problem in general, and how does that affect inflation rates going forward and GDP growth going forward? And there I just see a major drag from that particular aspect. That doesn't necessarily mean that I will be a permanent bear on growth or on equity markets, but it is one contributing factor which is extremely important for me.